Hi, everyone. Welcome to Wealthion's live coverage of the Federal Reserve meeting decision. I'm Maggie Lake, and with me today is Vincent Deluard, Director of Global Macro Strategy at StoneX. Hi, Vincent. It's great to see you.
Hey, Maggie, great to see you. Happy Fed Day to you.
Exactly. Okay, so we gave everybody a second to digest the news that came out. If you were multitasking, you didn't see it. The Federal Reserve cut interest rates by 0.5 percentage point. And Vincent, we should say that it was very divided going into this. The market split really on whether they would do 25 or 50, and a really robust argument around that. What do you make of the initial top line decision?
Well, I expected 25, so I will just be honest about it. I got it wrong. I mean, I think that the Fed had, sent these balloons, right, with, Wall Street Journal articles and try to get that 50 back in the curve. And apparently that's what they wanted to do. I would personally think that the CPI data, the jobs number, or the PPI certainly did not justify a 50 basis point move. But I guess we'll have to see what they said at the press conference to explain why they chose to do that.
Yeah. So, and just so everyone knows the cadence here, the decision came out, the initial details are out, but a lot is going to hinge on what Jay Powell says in that press conference. They're going to give a lot of color about behind why they decided to be more aggressive. And important here to point out, Vincent, you were not alone. When we say the market was split, it was, but a lot of the split came between economists and strategists such as yourself who really look at the data, who really pay attention to what's happening in the economy and with inflation and all the factors the Fed looks at, who kind of thought looking at it, maybe 25 was the right move and probably what the Fed would do. They tend to be a bit more cautious when they start a new cycle. And this is a change from hiking interest rates, right? This is the pivot that we all talk about. And then the market, which had run away with some of those sort of rumors and breadcrumbs in the Wall Street Journal and other places, and also just the market wanting to see something aggressive. So the market was pricing in 50. A lot of economists said, hang on a second, that's too much. So that's where we got that split and disagreement. That's why this press conference is likely to be so important. And if we look at the market reaction, the Fed's going to be watching this too. We saw an initial rally across the board for U.S. stocks, NASDAQ leading the way, risk assets. But, talk to me about that reaction function, because if the market starts rallying, this is not necessarily a good thing for the Fed, or is it? How do you think they're going to react to that? And what do you make of the gains?
Well, I first of all, I think the Fed is just going to ignore that and say, "Oh, we don't care. We pretend not to look at any of that," and that's going to be their boilerplate language. In general, I think the market rallying is bad news, because that means that you see an easier transmission, unless you think the economy is really in the doldrums and we need to really throw everything we have at it, which may be what Powell is going to say. I mean, I don't see it, but maybe if this is just an adjustment cut, and if the inflationary ambers, as I believe, are not completely dark yet, you're just adding fuel to the fire here. I mean, you're increasing the value of assets, you're easing monetary financial conditions, which are already very easy, and I think that increases the risk that 2 months down the line we have a pivot from the pivot.
Yeah. Which is why I asked you if they'd be looking at that, and especially going to be important to see whether it was a unanimous decision, because
I think there was a dissent. I think there was one dissent. I saw
one dissent. Okay.
Yeah.
These are all the headlines coming in while we're on talking. So, does this tell us? So when the Fed does something aggressive like this, we often think, do they know something we don't? Should we think that perhaps the Fed is worried about something in the system, or is growth slowing to the degree, is a recession knocking at the door, that the Fed would be worried enough to go 50? Is that how we should read this?
I mean, I would read it as the Fed is worried that it, should have cut in in July, didn't do it, and now it's trying to make up the lost ground, and so that they don't look too bad. I think the recession is, where you look at Atlanta Fed GDP now, it's at 3%. Housing starts are really good today. Unemployment rate ticked down in the last report. Hours worked increased. I would have many questions for Jay Powell, if I were in that room, like, what does he see that makes him think that we need, 50 basis points? I mean, we could very well have gone, 25 and then increase the speed if need be, but it seems like, why front load it so much?
Yeah. So do you think that there's very important to dig beneath some of the narratives here, right? And so do you think that the economy is slowing enough to face a recession? If not, why not? What are the things that you see that indicate the Fed should be a little bit more conservative here?
Well, so in general, I think we have this massive issue with statistics. It started before COVID, but it got worse with COVID, with quality of statistics. And we've seen that all these revisions, all these adjustments, very low response rate. So since that happened, I spent a lot more time looking at the daily treasury statement, which measures the cash coming in and out of the treasury general account, and specifically looking at tax collections, because I believe this is, tax collection, everybody pays taxes. We all hate to do so. So no one pays more than they should. And we can see that on a daily basis in the US. At this point, for the year, tax collections are up 9% from last year. And there hasn't been a change in tax law. So I don't think there's been any case in history where you've had people paying 9% more in taxes and the economy falling into recession quite immediately. And if we look at the more recent trend, and of course there's some volatility, right? I mean, some of the tax collection, you get more money at the end of the month, beginning, whatever. But adjusting for that, there is no sign of a slowdown. So that's what gives me confidence that the economy is not slowing. And then again, because there is so much uncertainty about the Fed's the BLS release, I look at anecdotal stuff, because at the end of the day, I mean, the world is just, a lot of anecdotes tied together. You look at TSA crossing, how many people are flying across the country, record high, 10% higher than last year. You look at restaurant bookings, you look at Red Book Index of retail sales, you look at concert attendance, all these kind of anecdotal stuff points to an economy that's doing just fine. So I legitimately do not know what the Fed is seeing other than this massive pressure. Basically the market's been, in my opinion, almost bullying the Fed into cutting by 50. And, contrary to prior instances where it happened, the Fed seems to have, given in.
Yeah. So if we look at, and I want to dig into a little bit more about sort of, what people should be thinking about when it comes to this, and maybe some of the sort of narratives to challenge that we hear out there. But when we look at the reaction, stocks are rallying. So if there's no recession and the Fed's now, lowered interest rates, positive for risk assets, positive for U.S. equities.
Yeah, of course. I mean, buy degens, buy, I mean,
Degens, degenerates, like everybody.
I mean, we have 3% inflation and, 6% nominal, 3% real growth, and the Fed is cutting by 50. I mean, of course, buy everything, guys. I mean, it's the Fed put, but with a strike price that's like way above anything that made sense before. And I would also look at gold. I mean, gold, gold is at what, 2,600 on the day? Yeah, it's almost got to 2,600. We have Fed cutting by 50 bips when the market is at an all-time high, and the unemployment rate is basically at a 50-year low, and inflation is 1.5% above target. So I would definitely be a buyer of anything that represents a real claim against the economy, because this is very positive for nominal growth, I would guess.
So, because there are people who are looking, we've been coming into this thinking, we saw the wobbles. Now we're sitting near record highs again for equities, but we saw those wobbles in the summer. There's been so much talk about the AI bubble bursting,
Right,
and people needing to get more conservative. There's so much volatility. We're, seasonally in a tough time for markets, but this seems like it just opened the gates for the bulls.
Yeah. I mean, there's only 12 days left in September, right? So better get that bear market going soon.
Well, with this as a backdrop, it doesn't seem like it. So, okay, maybe for those who were worried about their equity position, this is good news. What about if it is the case, we're looking at treasury yields look like they're rising a little bit. What does that mean for bonds? If it's good for stocks, is it bad for bonds?
I mean, I think it argues for steeper curves, right? I mean, you're gonna cut the short end more than people thought, and then I think the long end needs to start pricing this kind of hyper reactive Fed and the risk that uh, growth and especially inflation increase. So if you were to think like the cuts were going to come later and then you kind of front load them, it makes sense for the curve to be steeper and yes, the long end to uh, the long rates to increase on the day. I mean, is that what has been going on today? Let me check.
It looks like listen, we're all getting this. Like you look on your
I'm
terminal.
looking on my Bloomberg right now. The
Yeah,
10-year.
because
Where are we?
things are going to move quickly. So
Okay,
I
no,
would
it fell on the news and then bounced back. No, it's still at like 3.6, something
okay.
like that. I mean, which is still, if you think about it, an insanely low level for the 10-year, when again you have real GDP growth of 3% for 4 quarters now. Inflation still, some segments of inflation reaccelerating if you get shelter, if you get core services, and you have a very easy Fed and the chance that fiscal policy becomes even more accommodative after the election.
Yeah.
So I mean, I would be max bearish on duration at this point.
So we've got some interesting comments, and I just want to look through them because I think this is going to be the concern. Chris saying this huge cut emphasizes just how disastrous the U.S. economy really is. It's a question: is with this move, is it going to increase higher inflation? There's a tension here, isn't there, Vincent? So let me just break that apart. Is the U.S. economy disastrous? It sounds like you're saying no. And I teased out today, you said the Fed should pay more attention to hairdressers. What do you mean by that? We got to talk about this because you always think outside the box. What do you mean by that?
I mean, every CPI report, the first line I go to is haircuts, and the reason why I love haircuts is not because
Not because you have good hair.
yeah, no, it's not that great. I do super cuts, I mean, by the way, the inflation on that's how it all started. I was watching it. Super cut, you could get your haircut for like $10, and now it's like 30 with tip. I mean, it's kind of a, in a couple of years.
So this is your real economy indicator.
Yes, and I think that's interesting, because haircuts, we live in this world of change and disruption and deep fakes and everything, and haircuts is wonderful, right? I mean, the technology is, hands and a pair of scissors. The time it takes to cut hair about the same as it did 100 years ago. There is no supply chain. There is no Russia. There is no shenanigans. There is no OPEC. There is no AI. There is no semiconductor. All you get in a haircut effectively is, okay, I'm going to hire someone who hasn't gone to college to work on my head for about 20 minutes, rent a small space, pay utilities, and pay insurance. So if you think about what goes into core inflation, core service inflation, it's really wonderful. Another thing I like about haircut is probably the last sector in the U.S. economy where there's no cartel, private equity owned cartel that kind of manipulate the price. No, it is maybe the only point in the economy that actually approximates what economists think about when they think about the economy with a model of pure.
It's a clean read. It's a clean
a
read
very
on
clean
economic
read.
activity.
And it works. So for the past decade, we had, the price of a haircut rose by 1.8% from 2010 to COVID, which is exactly what happened to the overall CPI. So over time, it makes sense, because if you think about what inflation is at the end of the day, it's the cost of labor. Everything we consume is transformed labor one way or another, right? So it works. And since COVID, it reset to that 4 to 5% plateau. Now, it never went to 9%. Because the jump to 9% obviously was things like used cars or plane tickets, things that were impacted by the reopening and COVID and shocks to the supply chain. So it just went to 4, 5, 5, and this has been bouncing around there. And lately, I mean, I don't want to make too much of a read on this, but in the past 2 months, actually accelerated to about 6, 7%. And you see that most clearly with haircuts, but you see that also if you look at laundry, dry cleaning, childcare, nursing home. Anything that's kind of labor intensive, you've seen that reset from 2% before COVID to 4, 5%, which makes me think that we live in a 4, 5% inflation world. We just have a lot of noise coming from obviously oil prices have been jumping a lot, commodity prices have been jumping a lot, and also core goods, right, which is a part of the CPI that usually is kind of boring, but because we had all these supply chain issues, they went up a lot, and as the supply chain issue cleared up, they came down a lot. So that creates some noise, which is why I think the noisier the data, the more you want to focus on things like haircuts.
Yeah, I absolutely love that. It's so fantastic, and you're right. We're all trying to figure out how to sort of make sense of these economic readings that seem like they're a little harder to understand. So some other folks in the chat are talking about, is there a risk of hyperinflation? So I know you've been concerned about inflation, and in your report, you talk about some things that you see as an indication that we haven't tamed inflation. Because if the Fed's cutting 50, they're basically saying, like, we won the fight against inflation, right? But not so fast. Is that a risk that we could see a return to inflation? Maybe not hyperinflation.
Yeah, I mean,
Hyperinflation
hyperinflation, so there's I recommend you guys, Steve Hunker, I think, is the economist that's a specialist, and he has this amazing table of case of hyper. So he has this hyperinflation is something that has a clear definition. I think it's a monthly rate of inflation of about 50% for more than 28 days.
Yeah.
So we're talking like, I'm not even sure that Venezuela qualifies here.
Yeah, this is an extreme.
We're talking like, Zimbabwe or Weimar Republic or Hungary in 1946. So I am not forecasting.
To be clear.
I mean, price doubling.
You are comfortable saying that you're a bit of an inflationista.
Yes. No, what I see happening is a reset of inflation to, 4 by, and I would argue we're already there. That was the point of my little haircut story. It's been 4 years now that we've had, hairdressers making 4 or 5, or at least, I don't know if the hairdressers are making more, but certainly the cost of a haircut has been going up for 4.5%, 5% for 4 years now. If you look at most services, we already live in that world. I mean, the last sub 2% print was February of 2021.
And that's services. And when you talk about services, and this is why the haircutters are great, we're having some fun with it, but it is really important because a lot of our economy is based on services. And anecdotally, all of us know that. If you've gone out to eat, if you've tried to travel, all of the things that we do fall into the services category. And so while manufacturing has been weak, and you and many others have pointed this out, we have sort of dual economy, services have held up and been strong. You're also looking at shelter, which is important in CPI. You had a chart, I think we can pull up in your research. Why is that something we need to be paying attention to? And you're going to hear, owner equivalent rent, all these sort of fancy terms, but why does shelter matter? And what are you seeing there that worries you when it comes to inflation?
I mean, the weights, right? I mean, it's a 30% item in the CPI, shelter. So, if you're significantly above 2% on shelter, it's going to be very hard to make that up with other categories, especially when your core services like shelter are at 4 or 5%, right? So you need intense deflation in goods and commodity prices to make up for that. Now, shelter is important because shelter was the crux of the argument of the deflationist recessionists, was that the way the Fed measures shelter costs to the BLS and then feeds into the Fed is lagged, right? They have this survey where you ask people, how much do you think you would rent your house for? And then the panel of rents that they use rolls over slowly. So you're lagging. And the idea was that the Fed started hiking 2 years ago. We had a fall in, actually, didn't really have a fall in rent, disinflation in rent. So that's going to feed through the data, and we're going to see lower shelter prints. So we need to look at inflation X shelter. And if you did that for a couple of months, you could see that we were below 2% X shelter. Now, this relied on the premise that shelter was going to drop from that plateau of 4 or 5% it's been stuck at for many years now to something like 2%. And we saw that in June. For 1 month, shelter was at 2.1 or 2.2% on an annualized basis. But for the past month, July and August, we bounced back up and now above that plateau of 5%. My view is that June was the odd month. That was the problem. Because if you look at the end of the day, how do you set up the cost of a rent, right? You have basically 3 items. One is the cost of the building. Now, what do we know about real estate prices? I mean, you look at your Case-Shiller, it's at an all-time high. In all the 20 cities that go in the Case-Shiller, you have gains of more than 2% for the past year. I think on average about 6 to 7%. So the price of the building is going up. Second bucket is how much does it cost to maintain the building? How much do you have to pay for maintenance, for electricity, for insurance, for garbage collection, things of that nature. that's going up. We're going back to the service story, right? The cost of the hairdresser basically is the same. The cost of the maintenance guy is going up by 5%. So the cost of maintaining the building is going up by 5%. The cost of the building itself is going up by 5%. Now, the third item is the margin, right? I mean, how much does the landlord take? Landlords typically are not charities, especially now that we have, private equity owned real estate market. So I don't see how you can sustainably have shelter at even 3-4% with that. So if shelter, which is a 30% weight on the CPI, stays at 4-5%, and core services is reset to 4-5%, I mean, that's more than 50% of your CPI at that 4-5% level. Sure, you can be lucky, and to some extent we are lucky, right? We have these very weak energy prices. We have this record oil production that's helping. We still have we import a lot of deflation from China. We had a strong dollar, so we had all these kind of temporary things that really took it down and gives the Fed indeed some space to maybe cut. But we have not solved the problem. So I would stay at obviously not hyperinflation, but a reset to an inflation rate of 4 or 5% seems. I mean, it's what has happened. We just don't see it yet.
Which is again important, because we're talking about this on a day when the Federal Reserve just cut interest rates 0.5 percentage point. That's a lot. That's an.
By the way, remember that they were at 0. They waited until inflation was 8%. And I think they raised by 25, right? The first, I think in March of 2022, I'd have to check.
Yeah.
But if you look at the asymmetry in that reaction function,
yeah.
right? I mean, when you have high inflation, they wait for it to be 8%, 4 times the target.
To be really sure, but now on the way
0.
down, right?
And now we had one good CPI, I would argue. June was good. Last month was not good. It was not bad, but it was not good.
So I'm sure we're going to get people. And again, we're about 5 minutes away from the press conference, but we're going to continue to talk a little bit. I'm sure going to have people say, well, there are people talking about, and there have been, right? There have been not only politicians. We know that some of the politicians have been clamoring for an aggressive rate cut, but we know that some economists, some strategists.
Elizabeth Warren, right? I mean, she does that every month.
It's a regular view. But economists, and some of them are saying, well, look at trueflation, true readings of inflation. Why do you not look at that? Why do you think that that's not an accurate read?
So trueflation, it's not the same measure. I mean, just if you look at shelter, for example, I know shelter in trueflation is probably around 18% versus 30%. And there are other differences like that. Trueflation, I think, because of the nature, they aggregated a lot of prices over the internet. I think they're somewhat maybe more exposed to this kind of imported good deflation.
Okay.
So
okay. So this is why you can't pick narratives. You have to have a framework, because you can find some statistics that support your point of view if you want. So you have to really do the work to dig in. I want to switch to bonds, because there are a lot of people who might be listening to this who came to age, have always been advised about diversifying their portfolio. We talked a lot about 60-40, whether that made sense. It seemed like more recently it was back, or people were talking about bonds. I tweeted the other day, if you follow me, that I read a headline saying, one of BlackRock's main people said, with the rate cut is going to usher in a golden age for fixed income. And I found that interesting.
Was he a bond fund manager, maybe?
Yeah. Were they bond fund? Were they talking their book? You're asking, Vincent. Very good question. But I think it's really important, because people are trying to figure out right now, I'm worried about a bubble. Have the best gains? Are they in equity? Should I be more exposed to bonds? This is why we're spending so much time talking about inflation. If we're in a higher inflation environment, Vincent, what does that mean for bonds?
Well, so obviously, I mean, inflation is a great bond killer, right? You can have this debate about whether inflation is good or bad for stocks, and you have mixed evidence. I would argue that it's primarily good, especially if the Fed doesn't fight it. Right? Because at the end of the day, stocks are a real claim, right? I mean, they're a claim on a real asset. You own whatever, minus the debt. You own the company minus the debt. You own the fixed asset, and then you own a claim on the future cash flows. And these cash flow will grow at the pace of nominal growth. That's not the case with bonds. So I would argue that on balance, obviously, inflation is beneficial for stocks and negative for bonds. Now, it can be negative for stocks in the 70s when the Fed fights it, right? That's when it becomes a stock. Like in the 70s, famously, we had these two 50% plus bear markets, and equities on a real basis lost probably around 75% of their value in a decade, because the Fed funds rate went to 18%, right? When Volcker really went crazy, to state inflation dragon. Now, if you have a Fed that is not doing anything, yes, all else equal, it's bullish for stocks. And I know it hurts to say that, because you feel that stocks are expensive and we have this AI bubble and blah, blah, blah. But we live in a, you have to compare, like you have to do something with your money. So what did the Fed do today? It told you that money market fund that used to pay you 525, now it's paying you 475, and that's going to keep dropping. So I thought cash was attractive. Cash is becoming, relatively speaking, less attractive. Bonds, were not attractive at 3.5% on the 10-year. I mean, think about it. Like, okay, so 3.5, that's what you get with a 10-year bond, 3.5%. That's it. You will not get anything more. That, the coup, that's what you're going to get over 10 years. With stocks, yes, I agree. It's probably the multiple is around 22, right? So take the invert of that. That's about a 4.5% earnings yield. That earnings yield is growing at the pace of nominal growth. Now, I don't expect a recession. I think inflation is going to stay strong. So let's say that grows by, 3% inflation, 2% growth. You get 4.5% growing at 5% on one hand for 10 years or for infinity. And on the other hand, with the 10-year treasury, you get 3.5%. So if anything, yes, it's painful to from CFA, whatever, you don't want to, we can all see the signs of a bubble, but what are you going to do? I mean, maybe you can make a case that you can find cheaper stocks outside the US. I would buy that. Maybe you say, hey, I still want to have some cash, but when it comes to bonds, not just treasuries, but even if you could get junk bond, that's another part of the narrative that really shocks me is, okay, we're going to have this recession, right? Okay, it's terrible. The Fed needs to get by 50 basis points. What's the spread on junk bond right now? Probably 3.5%. I mean, it's in the bottom 5% of the level of spreads. So again, what you have to look at, what pays you, what are your options? I mean, is it duration? Duration doesn't pay you. Is it credit risk? Credit risk doesn't pay you. So yeah, your equity risk premium is actually looking quite good.
So a couple of important questions. That I want to ask you. And as I'm looking at this, stocks are bouncing around, and we expected this to happen because there was a lot of decision. They're up, but they sort of rallied a lot, and then they sort of came back and they rallied because they're trying to work through a lot of the tensions that Vincent's talking about. If it's positive for stocks, do you expect, or would history dictate that it goes to, once again, the risk assets, tech, mega cap tech? Is that the area? And does that happen once again at the expense of some value stocks?
Well, I mean,
Or could we see rotation? Could it look different this time if it's equities?
I think we've tried way too hard to placate narratives on tech and the relation between tech and interest rate. It's a complex one. If you go by CFA textbook, discounted cash flow model, okay, if you earn a lot of your cash flows in the far future, which is not true for all tech, right? I mean, Meta, for example, gets a lot of cash flow today. It's not that clear that NVIDIA will be able to maintain this high growth rate, but generally it's thought that tech stocks like Amazon, most of the value of Amazon will be realized, 10 years and above, as opposed to, say, an old company that trades for 5 times cash flow. So theoretically, if you lower the discount rate, the value of these cash flows that are far out in the future is bigger today. So the long duration assets, which include tech stocks in theory, should do better when rates are lower. Now, the question is, which rates are we talking about, right? Because what the Fed cut is the overnight rate. Seems to me that if you look at the 10-year yield, the 10-year yield is kind of flattish on the day, right? So you have to look at the 10-year or the 30-year to make that calculation in proper term. The reason I put these caveats before I started this is because you could basically, we placated narratives. And another narrative that worked quite as well was, oh, these guys have a lot of cash, right? Apple famously sits on 200 billion cash. So when the Fed raises rates, they actually make money. I mean, Apple is a money market from these guys as a phone company. I think the reality is that, hey, big tech, large cap stocks have gone up like crazy for 5 years now, and then we've just try to justify this with, oh, that's because of the interest rate channel, or that's because of the duration channel. But I'm not sure that the two are necessarily related. If anything, I would think that lower rates probably help more small caps, because most small caps have more debt. Some of that debt is more kind of short-term oriented. So the ability for them to refinance at a lower rate probably matters more than for an Apple, which is some 50-year debt, and that has more cash and they know what to do with. So they don't get, the business is not impacted by what the Fed did today.
That's a great point, because that was what we talked about when rates were increasing, that it was going to be very difficult for some of those smaller that are much more dependent on that shorter term financing. So of course it would make sense on the flip. So this is my second question, and you touched on it there. The Fed cut its overnight Fed funds rate. We all think that immediately impacts the bond market. But if you are seeing the risk that inflation is still bubbling and may increase, and the Fed has now kind of poured more liquidity or gasoline on things, it doesn't mean that treasuries can't go up even though the Fed is cutting rates, right? They used to call them bond vigilantes. But when the bond market is not happy with inflation, we could see rates go up. We haven't seen that in a long time, but is that a risk?
Yeah. So on the whole, what was the word that your BlackRock guys, the golden era for bonds, golden age, or?
I just read the headline. I'm not saying for sure. He did not tell me personally. I just, well, before you go after BlackRock, everybody, and get me in trouble.
No.
But it was a very widely publicized headline.
Golden age for bond. You have to look at
fixed income. Yeah.
Fixed income. What's priced, right? I mean, we went from 5% on the 10-year to 3.5, 3.6, right? So 1.5% drop in yield. Typically, a 10-year has a duration of 9 to 10 years. So let's just use 10 for simplicity. You had a 15% rally in bonds already. So I would argue, and this is, bonds should be boring, right? You should not expect to make, 15% in bonds in any given year. So I would argue that we already had our golden age for bonds. It was, the past 6 months. For this to continue, you need to make a case that these rates are going to keep falling, including where it matters at the long end. So that will get to maybe 2% on the 10-year. I mean, I'm not saying it's impossible. Before COVID, we went even below 1% at one point. So it's not impossible, but it's a balance, right? To me, we are still in an economy that is growing at or above potential, with inflation that is still way above the target, with a Fed that has missed its target for 4 years straight, and at the first time of this inflation is responding with bazooka cuts. So what does that tell you for the term premium? What does that tell you for inflation expectation? Probably should be higher. So that's why I'm not a buyer of the golden age for bonds.
We have another chart that you put in your research, which talks about the government debt. If we could pull that up. And this is another reason that you're concerned about the inflation outlook, but some people may also point to it as a reason that the Fed is being aggressive, because the need to pay those make those interest payments. It's hard to sustain high interest rates when you've got spiraling government debt. What do you see happening here? And how do you address people who say, well, it doesn't matter. Government debt doesn't matter?
Well, so I mean, I think what you're referring to is the idea of fiscal dominance, right? Is as you raise interest rates, the cost of servicing the debt for the government, especially when you have a highly indebted sovereign, which is our case, right? Basically, with 100% debt to GDP. So let's say you go from 0% to 5%, suddenly you have a 5% of GDP item that's, becomes larger than what you spend on defense or entitlement, or even both of them combined. So that's an argument that, the Fed is basically trying to make life easier for the Treasury by lowering rates. If that is the case, they will never tell us that.
They will never tell us that.
Right.
No one will tell us that.
I will let the viewers come to their own conclusions on this. What I was pointing out about the deficit was, I think, something that people missed earlier this year, is that the deficit was actually shrinking compared to last year. If you compare to last year, we're running at about 400 billion less.
Is that because of the strong tax collections?
Yes, because In my view, that was because the economy was doing well, so people were paying taxes. But the more people pay taxes, that shrinks the deficit. That means a lower fiscal impulse. So to the extent that we had weakness in economic data this summer, I would attribute it to this kind of weaker fiscal impulse, which you could also see in the job reports. If you look at this bad job report, the one for July, it came from the government sector, not so much the private sector. So that was my take, was that we had less of a fiscal impulse in the first half of the year. But this, I was pointing to this deficit in August. We had an operational deficit of 350 billion in August. Now some of that is calendar effects, right? Basically, there was some expenses because August is the longer month that that were double counted. So it was not entirely true that the 350. Obviously, we are not annualizing a deficit of $4 trillion. That's not true. But even so, take that off. Look at things that are recurring. One of them is the interest expense. So typically coupons are paid on the 15th of August and every other month like that. We had a 64 billion coupon payment on August 15th. Last year, it was just 54. So you could see, I think that was what you were pointing to, the impact of kind of higher rates on the deficit. Now, typically, the idea is that, higher rates are restrictive because they force the government to cut on the rest of the budget. That's what, for example, happens in Europe. Say you have a 3% deficit target, interest rates go up. Well, you're gonna have to cut something else. If you're gonna pay more in interest rate, you're gonna have to pay less in social security or in education, something like that, and that what slows the economy. Now in the U.S., we have this very exorbitant privilege of not having to care about the deficit effectively. Oh, I have to pay more on interest rate? Fine, I'll just pay more, but I'm not going to cut anything. And effectively, we have not cut anything else. If you look at federal salaries so far this year are 7.6% higher than they were last year. 7.6%. It's nice for the government. Very, very nice. Social security benefits are up by 6.5%. So again, we have this also Medicare spending is up by 12%. So, and these are big programs. I mean, there's about 3 million government employees. There's probably about 70 million people on Social Security. Medicare is everybody above the age of 65. So we have this kind of structural growth in spending.
Well, this is where inflation comes into play, because some of this is benchmarked off of inflation. And so this is where
but
you
inflation get that. and some, right? I mean, for Social Security, you have a cost of living adjustment. For last year, it was 3.5%. And then the actual benefits paid so far for the year are by 6.5%.
Right.
So a lot of that probably has to do with the number of people, right? You have all your boomers, right? Your median boomer is, probably turning 65 this year. So you are getting to this high birth cohort. So you have more people collecting benefits than people dying. So that's part of the story. For the federal government, I'm not so sure, by the way, because I don't think we have a big increase in the number of federal government employees. I think this might be just, straight up pay increase. Might have to do with the fact that there's an election in a month or so.
Exactly, trying to hang on to talent, I guess, or pay them to go campaign. So we have a situation, and again, Jay Powell's going to be talking, so we're going to watch this. But if you're thinking about your portfolio, you're right, you're not day trading this, so it's okay. That's the good news, right? You don't have to respond to the headlines. Against this backdrop now, and you mentioned not only did we get the cut, Vincent, but it looks like they're anticipating more cuts in the future. Right now, this is because once the Fed goes, they usually begin a series of rate cuts. So this may be the first in what will be more rate cuts.
So you can see that from Fed Funds futures market. So I'm looking at the screen. I mean, I could even show it here. I don't know if you can see it here. Okay, so implied number of cuts for November is 1.4. So that means we basically are where we were before this meeting, when it was split between 25 and 50 bips. So the market is half, of course, 25 is priced in, and about half the market thinks it's going to be a 50 in November. I mean, 250, that's crazy. And then by December, we have 3 cuts priced. So basically what it's telling us is they're going to cut by 25 in the next 2 meetings. And then there's going to be another 50 somewhere, either in November or December.
Yeah.
So yeah, that would be
very aggressive. This would be a Federal Reserve that would be responding to a dramatically slowing economy or some other problem that they see. No doubt well, we hope that someone's telling Jay Powell that before he goes out to that press conference, because this will be one of the things that the Fed tries to massage is
Yeah, I suspect they're gonna try to talk it down a little bit,
one would
because
think.
it's not a good look, right? Then it makes you think that, oh, the economy is collapsing, which I don't think is the message they want to convey. I think if I'm the Fed, I'm trying to do this kind of mission accomplished, right? Look, inflation has fallen. The Fed funds rate was 5%, neutral is 2.7, so I'm just cutting to ease, but I've actually nailed that soft landing, and the economy is fine. So if the economy is, as that narrative that would not justify, if you're doing adjustment cuts, you're doing something like maybe 94, 95 or 97, 98, you just do a couple. You don't go by 50 bips increment to do adjustment cuts. Adjustment cuts are 25. So
yeah. Is this which by the way, Vincent just laid that out in much clearer language than you will ever hear from a Fed official. Believe me, you'll have to have the Google translator out, because they never say anything that clearly. But do you, again, in a backdrop where the economy's still growing, they've cut interest rates, maybe as an insurance policy to help around the margins for those who are feeling the squeeze of borrowing costs. And it'll be good for stocks, may not be disastrous for bonds. That sounds like a pretty doable situation, in a situation that's pretty benevolent for people's portfolios. What would be the risk that you would say we need to watch out for as we look out the horizon? Because I said, we're not day trading this. So, when you roll up and people are having conversations with their financial advisor, what should they be thinking about?
Well, there is the risk that I'm completely wrong about growth and the economy, which, I would like to be open to that, and that the Fed is seeing something lurking behind that I'm completely missing, like some, banking crisis around the corner. And what's happening here is like, 07, right? When the Fed cut at all-time highs, and, 12 months later, stock market had lost 50% of its value, and we had, a global recession. That's a risk. Now, I'm not seeing it, but maybe there's something that the Fed sees and I'm not aware of. I mean, we had, the yen rally a lot. That was not a very good sign. Unemployment rate. I mean, all the classical recession stuff. I don't think it's a high risk, but that's a risk. To me, the bigger risk is, again, the risk that growth is actually reaccelerating already, and that we will get now we have, I mean, if you think about, what influences growth, first of all, I'd like to disclose, just to level set, growth is the natural state of an economy. All else, because we are getting smarter over time, we are getting more efficient. So if you have your prior for the economy should be that it's growing. I think people need to make a proactive case for a recession. And then what influences growth? Well, it's the stance of monetary policy. Now, I would argue that monetary policy was maybe neutral, and now we're accommodative, but certainly the stance of monetary policy is easing. We can all agree on that. Fiscal policy, we're running a deficit of 6% of GDP at full employment. Now, for a couple months, that deficit shrank a little bit because of the timing of the tax receipts, but that's going to move more accommodative. So easier. Next one is financial conditions. How are spreads? Is it easy to borrow money? How are animal spreads? Stocks are an all-time high. Junk bond spread are, probably in the 5% lowest that they've been. So you have very easy financial conditions. Next one is the price of oil, commodities. It's been falling all summer long. And then the last one would be the dollar. And the dollar has weakened, and it's weakening some more because of what the Fed does. So what's likely going to happen? Is growth going to decelerate, or is it going to accelerate? I see a lot more in the...
Yeah, those are all pro-growth.
These are all growth positive.
So if
and again, we start from a baseline of real growth of 3% in the past 4 quarters. So positive for growth in an economy that's already growing above potential.
So you're leaving open the idea that maybe you're wrong on growth, but for all the reasons that you just said, you're feeling like that's not. So what's the other risk so because if you're thinking about what do I need to hedge against, right? That's always what the real conversation is. Where could I get my gains?
Right.
What do I need to hedge against if something goes wrong? So maybe a recession, but what's the flip side? What's the other thing that would be the concern? I guess inflation, right?
Yeah, it's a reacceleration of inflation, and the Fed has to pivot the pivot, right? We're joking about that, but maybe I would call that probably today is going to be remembered as a reverse Trichet. So Trichet was the famous French central bank of the European Central Bank that hiked rates in 2008, just as the economy entered the global recession, and then he did that again in 2011, just as we had the Eurozone. So twice he hiked rate, and then the following meeting he had to cut it. Now it may not be that immediate. I don't expect them to hike back in November, but in 6 months, yeah, there's a good chance of that. Now, how do you hike against that? I mean, you can take a position on rates future or options on a higher Fed funds rate in 6 months. I mean, that's probably really, really cheap right now because everybody's pricing more cuts. You can do that with commodities, gold, obviously. I mean, if we have this, if this is just the new normal, and the theory you hinted at with, oh, maybe the Fed is just helping the Treasury finance the deficit. If that's the case, then you don't own enough gold.
Exactly. Well, it seems these days all conversations lead back to gold, and there's a reason. Vincent, I know that you're anxious to go check in, and we all are, to see what Jay Powell is saying, and what it might mean. But thank you so much for helping us understand the circumstances and really like zero in on the things that we should be pushing back on a little bit, or at least really investigating this tension between growth and inflation. They can't both be right. Like if you think there's going to be recession, then what does that mean? If you think there's not, and you feel like the economy is going well, then you've got something else to worry about. That's inflation, and you should be thinking about both those things when it comes to your portfolio. So I think that positions everyone really well to listen to the conversation from the Federal Reserve. It seems like this is we have an election, which we didn't even get into. It seems like this is not a period where people can be very complacent about what's happening. Do you expect volatility through the fall? It seems like that's coming up a lot.
Do I expect what? Sorry?
Volatility through the fall.
I mean, we might see it in the press conference. I mean, everything we talked about in terms of market reaction might be undone because of one bad word that Powell may say in the press conference. And I actually suspect some of that is going to happen because typically the Fed likes to, give with one hand and take back with the other hand. So if we have a very dovish statement, then maybe we'll have a bit of a more hawkish press conference. I mean, I would also say you can go crazy trying to day trade that stuff. Maybe, I mean, if you want to have fun and and give commissions to your broker, go, by all means, go for it. But maybe the main message we should get again is hey, the Fed is cutting by 50 basis points when real growth is at 3%, inflation is way above target, and they only hiked by 25 bips when inflation was at 8%. What does that tell you about their reaction function? What does that tell you about the kind of target that they have? Are we still in 2% world or not? And to me, everything points to the idea that we are no longer in a 2% inflation world, that inflation target is at best a floor that I think we won't even touch, and that we are in this kind of structurally higher inflation, higher rate, higher growth environment because we have policy that is adding stimulus on top of stimulus.
Fantastic. I love your research and your thinking. It's always outside the box. You're super original thinker. And I think we needed this at a time when we are going to have to make our way through this volatility and are facing a pivot now from the Fed and all that brings with it. So thank you so much. I appreciate it, Vincent.
Thanks, Maggie.
And thanks to all of you for watching. We'll see you again next time.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.